Hello and welcome to DIY Investing YouTube channel. We're working through every company in the S&P 500, and today I'm reviewing Restaurant Brands International, ticker QSR. For the next few minutes, I'll discuss both my valuation of the company and my thoughts on its business quality. Now let's dive on in. This one comes as a request of one of our listeners. The industry is hotel, restaurants, and leisure. Market cap $23 billion, EV $35 billion. So there's a substantial amount of debt on this business. They operate as a quick service restaurant company in Canada and internationally. It's 4 segments: Tim Hortons, Burger King, Popeyes, Louisiana Kitchen, and Firehouse Subs. Own and franchise various chains. These chains for basically restaurants. They have 29,000 in 100 different countries based in Canada. So return on assets 3%, return on invested capital 30.4%, return on equity of 11%. These numbers are pretty low. We can see basically they've been profitable every year, beginning in this history is beginning in 2013. And we see 10%, 1.3, 2%, 3.6, 3%, basically a 3 or 4% return on invested capital. This is quite low. So I don't like what I'm seeing here, return on invested capital. I don't understand necessarily why it's so low. And because we have less than a 10-year history, we don't get 10-year CAGRs. However, we can see that despite these low return on invested capitals, there's a lot of leverage on this business because the return on equity is being posted at 11.8%. So when you look at return on equity down here, we can see the last few years, 11%, 15%, 16, 12, and 22%. The return on equity numbers are acceptable. I like to have a return on equity of 15% or greater, and we can see 1, 2, 3 of the last 5 years we've been above that hurdle, and it's been getting a little bit better. So potentially this business is going to have enough returns to justify us being an equity investor, but clearly there's a lot of leverage on this business, and they're working really hard to grow because they've grown from basically $1 billion in revenue in 2013 up to $5.7 billion in revenue in 2021. So there's been substantial growth in these revenues and earnings as well. Let's see, EPS growth has been a little bit all over the place. I guess 2020 is partly disguising the performance here. So if you take 2020 out, then you maybe have 4 straight years of 15% returns. So a lot of good numbers here that we can see. Now the ratio of PE of 27 seems extremely high, but maybe we can get some better look on it as we dive into the financial statements. If you're liking this video so far, please hit that like button and hit that subscribe button as well. When you subscribe and ring the bell, you're going to get notifications that I upload new videos each and every week about investing topics. So when we look at the income statement, we can see that shares outstanding has been declining, but not substantially over time. It kind of declined in 2017 and then boosted up over a 2-year period. So maybe they issued some shares. There's also a big gap between basic shares outstanding and diluted shares outstanding. So that suggests some major dilution is happening, and I don't really understand why this gap is. It would take reading the 10K to really understand where that gap is coming from. You can see 10 straight years of operating profits. That looks pretty good. This net interest income means that they're really paying a big amount of interest expense due to the leverage on this business. I mean, look at this. It's basically a third of your operating profit is paying off interest. So it's definitely highly leveraged. The balance sheet. So you can basically see they've taken their PP&E from 800 million up to 3 billion. Goodwill has gone up a huge amount, up to $6 billion. You have a lot of intangible assets. This entire balance sheet is heavily intangible asset based. So on the tangible assets, your performance is actually pretty good. If you look at current assets of $1.8 billion, you add to it your PP&E of $3.1 billion, maybe you have $5 billion in assets. When we take that to the income statement and we look at our operating profit, then it looks very different. And so your $5 billion in assets, maybe you have a return of 20%, 18% return on invested capital. However, there's a lot of intangible assets. They're doing acquisitions that you really need to take into account these intangible assets that they're putting in, because it suggests that the managers are having to pay up in order to grow. And so you should take that into account. But when you think about the actual underlying business, maybe the returns on capital are worth sticking with because they are relying on these intangible assets, and the underlying businesses might be performing very well. Likewise, you see these capital leases have grown. So they're probably leasing some stores, and they've long-term debt has gone up significantly, 6x, 2.8 billion to 12.9 billion. So it's very leveraged, especially when you think about the fact that you have $12.9 billion in long-term debt, but your actual assets is 1.8 billion plus is 5 billion. So you have almost 2.5 times more debt than you do tangible assets. This is an incredibly leveraged business, which means that if it works out, it could work out really well, but it could also go really poorly if it doesn't. So you see cash flow from operations here. I don't know where this, so you have a lot of stock-based comp or something, but I don't know where this dilution is coming in. Oh, you have preferred stock. Maybe that's where the potential dilution is. This is a very difficult business to analyze because you can see this big acquisition here. You can see the acquisition in 2017, another acquisition in 2021. They're putting a lot of money into acquisitions, substantially more than their cash flow from operations. That's why they're having this big dilution here. It's why they're having this big amount of debt. All of these things are playing into those numbers that we saw before. I don't know. This company is really hard to analyze based upon the numbers because although you have some nice pieces here, the return on actual invested capital when you take into account the intangibles is low. When you take up on the tangibles, it's high, but they've basically leveraged the whole balance sheet with that debt. You have 2.3 times debt to equity. It's a significant amount of debt. Your debt is actually more than your tangible asset base. So it looks like a very risky company. Potentially this means that, you're leveraged for growth and it could work out well. But for me, it's a pass because that's just too much leverage, too much risk for the company. So this was Restaurant Brands International, ticker QSR. If you like this video, please hit that like button. Please subscribe and ring the bell so you can get notifications as I upload new videos each and every week on investing topics and individual companies. Thank you for listening, and until next time, stop paying fees, start building wealth.